Welcome back to the Daily Crypto Deep Dive. Oil has crossed $100 a barrel. Two of the world's most important shipping routes are under threat. Bond yields are climbing, inflation fears are returning, and traders are once again discussing the possibility of more interest rate hikes. Ordinarily, that combination should be absolutely brutal for Bitcoin. Yet Bitcoin has not collapsed. It has fallen back towards $64,000, and it is clearly under pressure. But there has been no sudden plunge toward $50,000. There has been no complete institutional retreat. There has been no obvious panic across the entire crypto market. So, is this proof that Bitcoin is finally becoming a genuine safe haven asset? Or is the market simply underestimating an oil shock that could eventually hammer crypto? Today, we are going to explain exactly why $100 oil matters, why Bitcoin has survived so far, what investors may be misunderstanding, and the specific point where this situation could become extremely dangerous. And at the end, we will give you our prediction for what happens next. Before we begin, take 2 seconds to follow Crypto News Today and leave the podcast a 5-star rating on Spotify. It helps more people discover the show and allows us to keep producing these daily deep dives. And before we get into the full story, a quick word about KRAKEN. KRAKEN is one of the longest established cryptocurrency exchanges in the industry, offering access to Bitcoin, Ethereum, XRP, and a wide range of other digital assets. Anyone who signs up to KRAKEN through our link in the description and completes their first qualifying trade can message us to claim 20 XRP from Crypto News Today. Using our link also supports the podcast without costing you anything extra. This is not financial advice. Cryptocurrency prices are highly volatile, and crypto trading involves a genuine risk of financial loss. Never invest money you cannot afford to lose, and always complete your own research before making any financial decision. Now let us get into it. The first thing we need to understand is that oil reaching $100 is not merely an energy market story. Oil is built into almost every part of the global economy. It moves the lorries that transport food. It fuels aircraft. It powers ships carrying products around the world. It affects agriculture, manufacturing, plastics, construction, and the cost of getting almost anything from one place to another. When oil rises sharply, businesses face higher costs. Some businesses absorb those costs and make less profit. Others pass the costs on to consumers through higher prices. That is why an oil shock can quickly become an inflation shock. And inflation is important for Bitcoin because it influences what central banks do with interest rates. The chain reaction looks like this. Oil rises. Inflation expectations rise. Bond yields rise. The Federal Reserve becomes less willing to cut interest rates and may even consider raising them. The US dollar becomes more attractive. Borrowing becomes more expensive. Investors become less willing to own volatile assets. And Bitcoin normally suffers. This is one of the biggest misunderstandings surrounding Bitcoin. Bitcoin may have been designed as an alternative to government-controlled money, but in the modern financial system, it still trades heavily like a high-risk macro asset. When global liquidity expands, Bitcoin often performs extremely well. When real interest rates rise and liquidity contracts, Bitcoin usually struggles. That does not mean Bitcoin's scarcity is irrelevant. It means the price people are willing to pay for that scarcity is still strongly influenced by the wider financial environment. And the environment has become considerably more dangerous. Brent crude briefly moved above $100 after attacks on Saudi oil tankers increased concerns about disruption in the Red Sea. At the same time, traffic through the Strait of Hormuz has remained severely restricted. Before the conflict escalated, approximately 20% of the world's crude oil supply passed through that narrow stretch of water. The Red Sea and the Strait of Hormuz are not obscure locations that traders can simply ignore. They are critical arteries within the global energy system. If disruption spreads across both routes, the problem is no longer merely the price of crude oil. Shipping costs rise, insurance costs rise. Tankers are forced to take longer routes. Refined products such as diesel, aviation fuel, and petrol can become considerably more expensive than the underlying crude. That is when an energy shock begins spreading through the wider economy. JP Morgan analysts have estimated that each additional month of serious disruption could add approximately $7 to $8 to the average Brent crude price. Under their scenario, 3 months of disruption could push the average toward roughly $114. That distinction is critical. The market can survive oil briefly touching $100. It will struggle much more if oil remains above $100 for several months. And that helps explain why Bitcoin has not crashed yet. Markets do not only react to what is happening today, they attempt to calculate what is likely to happen next. Oil crossing $100 for a single session is frightening, but it does not automatically create permanent inflation. Traders are still attempting to determine whether this is a temporary geopolitical premium or the beginning of a lasting supply crisis. Today's reversal in oil is a perfect example. After settling above $100, Brent fell back toward $96 as traders took profits and reports emerged of another attempt to restart talks between the United States and Iran. That does not mean the danger has disappeared. It means the market still believes there is a realistic possibility of de-escalation. As long as that possibility remains alive, investors will be reluctant to price in the absolute worst-case scenario. This is also why Bitcoin can fall to $64,000 without completely collapsing. The market is nervous, but it is not yet convinced that the global economy is entering an uncontrollable inflationary spiral. The second reason Bitcoin has remained relatively resilient is that recent inflation data has been less damaging than feared. U.S. headline inflation remained elevated at 3.5% in June, but it had fallen from 4.2% in May. More importantly, core inflation, which excludes food and energy, fell to 2.6% and was unchanged on a monthly basis. That gave investors some hope that the oil shock had not yet become deeply embedded throughout the economy. Central banks normally look beyond a temporary increase in energy prices because they cannot produce more oil by raising interest rates. The real danger appears when higher energy costs spread into wages, services, rent, transportation, and long-term inflation expectations. If that happens, the Federal Reserve may feel forced to respond. But if oil falls quickly and underlying inflation remains controlled, the Fed may decide that raising rates would cause unnecessary damage. That is the debate taking place now. Some investors believe the bond market has become too aggressive by pricing further rate increases. Others believe the Federal Reserve cannot ignore oil, tariffs, and a still resilient U.S. economy. That disagreement is keeping Bitcoin trapped rather than sending it decisively in either direction. The third reason for Bitcoin's resilience is institutional demand. U.S. spot Bitcoin ETFs recently returned to net inflows after a prolonged period of withdrawals. The new inflows have not been enormous compared with the billions removed during the previous outflow streak, but they have provided a consistent buyer during periods of weakness. That matters. In previous crypto cycles, a geopolitical shock could cause retail investors to panic while there was very little automatic demand waiting beneath the market. Bitcoin now has ETFs, corporate treasury buyers, investment funds, and professional trading desks participating at a far greater scale. Those buyers do not prevent Bitcoin from falling. They can, however, absorb some of the forced selling that previously caused much more dramatic price movements. The Bitcoin market has also already experienced a substantial reset. Bitcoin fell toward $58,000 during June before recovering into the mid-$60,000 region. Leverage was removed, excessive optimism cooled, and weaker holders were forced out. A market that has already declined and cleared out some leverage is often less vulnerable than a market sitting at an all-time high with everyone positioned for continued gains. This does not make Bitcoin invincible. It simply means the market was not entering the latest oil shock from a position of extreme euphoria. And remember, holding your own crypto securely becomes even more important during periods of geopolitical and market instability. Our ledger link is available at the top of the episode description. The fourth explanation is uncomfortable for Bitcoin supporters. Bitcoin is not necessarily holding because investors suddenly see it as digital gold. It may simply be holding because almost every major asset market is still waiting for more information. Gold has also struggled as bond yields have risen. Technology stocks have come under pressure but have not completely collapsed. The S&P 500 has remained relatively resilient because corporate earnings and artificial intelligence investment have continued supporting the market. Bitcoin is effectively caught between two forces. On one side, oil, war, tariffs, bond yields, and rate hike expectations are pushing prices lower. On the other, ETF demand, regulatory progress, corporate adoption, and expectations of eventual monetary easing are providing support. Neither side has gained complete control. That is why Bitcoin looks resilient but has also repeatedly failed to break cleanly through the $67,000 area. It is surviving, it is not yet thriving. And this is where we need to discuss what could actually break the market. The first danger would be oil remaining above $100 rather than briefly touching it. A sustained increase would begin appearing in petrol prices, transport costs, airline fares, and consumer inflation. The second danger would be the U.S. 10-year Treasury yield moving decisively beyond the current 4.71% level. Some market strategists see the region between 4.75% and 5% as a major pressure point for risk assets. Once investors can receive close to 5% from government debt, owning volatile assets becomes less attractive. Higher yields also make the dollar stronger, increase borrowing costs, and reduce the present value of future corporate earnings. Bitcoin does not produce cash flow or pay interest. Its opportunity cost therefore rises when safe assets offer higher returns. The third danger would be renewed ETF outflows. Recent institutional buying has helped support Bitcoin, but those inflows remain small compared with the money withdrawn during May and June. If oil remains elevated and ETF investors begin pulling capital again, Bitcoin could lose one of the main forces currently absorbing selling. The fourth danger would be escalation at both major shipping routes. The market is already dealing with severely restricted traffic through the Strait of Hormuz. If the Red Sea becomes effectively unusable as well, Saudi Arabia and other producers would have fewer reliable alternatives for moving energy to global buyers. At that point, traders may stop treating the situation as temporary. That psychological change could be more important than oil touching any particular number. Once markets believe disruption will last for months, prices begin adjusting immediately for the inflation and economic damage expected in the future. So, what is our prediction? We do not believe $100 oil automatically causes a Bitcoin crash. The market has shown that it can absorb a temporary geopolitical spike, particularly while ETF demand remains present and underlying inflation is cooling. We believe Bitcoin can continue trading broadly between $60,000 and $68,000 while investors wait to see whether the conflict de-escalates. But we also think the market is being slightly too relaxed about the risk of duration. The biggest threat is not oil touching $100. It is oil averaging above $100 for several months. If Brent remains elevated, the U.S. 10-year yield moves above 5%, and the Federal Reserve confirms that further rate increases are required, we believe Bitcoin will lose the $60,000 level. That could open the door to a move toward the mid-$50,000 region, as leveraged positions are liquidated and ETF sentiment weakens. However, if negotiations restart, shipping traffic begins normalizing and oil returns below approximately $85, Bitcoin could respond extremely quickly. The pressure on bond yields would ease. Rate hike expectations would fall. Risk appetite would return. And Bitcoin could finally make another serious attempt at $70,000. Our central prediction is that Bitcoin survives this test, but not because it has become completely immune to war or inflation. It survives because markets still expect the energy shock to be temporary. If that expectation proves correct, Bitcoin's resilience will look impressive. If that expectation proves wrong, the real sell-off may not have started yet. The next move will not be decided by a chart pattern or a social media prediction. It will be decided by oil tankers, shipping routes, inflation data, and the Federal Reserve. For now, Bitcoin is holding the line. But the longer this conflict lasts, the more expensive that line becomes to defend. Follow Crypto News Today for daily coverage. Leave us a 5-star rating on Spotify, and share this episode with anyone who believes Bitcoin is completely disconnected from the traditional financial system. And over the coming weeks, we may discover exactly how strong Bitcoin has truly become. We will see you at the top.